Good evening, all the joinees. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Markets. Let me introduce our topic for today. Today, in the webinar specific discussion, we will discuss how we will review client portfolios in an effective manner. And in that, we will understand how we can compare the performance of the portfolio against a benchmark. While comparing it against the benchmark, we will have a look at multiple parameters, meaning its cumulative return against the benchmark's return. We will understand how the portfolio measures up against the benchmark if we consider Sharpe ratio as a parameter, volatility as a parameter, which is nothing but an indicator of risk that the portfolio undertakes as compared to the benchmark. After that, we will typically have a look at understanding contribution analysis in portfolio analytics tab. So contribution analysis will typically help us in understanding what is the component contribution of every single constituent of the portfolio in contributing to the overall portfolio return, right? And we will actually build scenarios there. Once that is through, we will then understand how we can evaluate the strength of any of your client portfolios or even your model portfolios by understanding the drawdown analysis and the scenario analysis. Lastly, we will throw the forum open for a Q&A session wherein you can get your questions answered by either typing it in the chat box or directly unmuting yourself to speak. So let us now begin. For the webinar purpose today, I will be directly heading over to the portfolio section. So as you know, this is the landing page of NGEN Markets. Today for the topic related discussion, we will be specifically discussing on the portfolio section. So when you go to the portfolio section, a list of all the portfolios that would be saved by you will appear here. So in this case, today I've taken an example of a model portfolio test, which I've already made. From this drop down, in order to run the detailed portfolio analytics, I will just click on this drop down button and click on run, the first option. The moment I do that, a detailed portfolio analytics on this particular portfolio will be run. First of all, at the glimpse, you can see that this particular portfolio has 9 components. Okay, so it's a portfolio having 9 mutual funds. And each of this, as you can see, is equally allocated. So each of the component typically has equal weights in this particular portfolio. And this is something that I've purposely done so that typically when we come to contribution analysis, we can actually understand what is the contribution of each of the fund, irrespective of the bias that, okay, one fund is highly weighted and one is not, right? That bias will go away. So as you can see, each and every component in the portfolio is equally allocated, right? So first of all, at the glimpse, you can see that, okay, this portfolio is being benchmarked against reference index 2. Now, what is reference index 2? Reference index 2 has been chosen from one of the NGEN inbuilt benchmarks. As you can see, the current benchmark is from the NGEN bucket, and reference index 2 has a combination of 90% Nifty TRI and 10% CISL bond index. That is the weighted average of two indices that are really considered for building this benchmark. And as is visible right here, you will see that there are some inbuilt benchmarks that are saved in, it would be there in your NGEN login as well. So it will range from 100% Nifty TRI, and there will be a consistent step up, right? So extreme top will be 100% Nifty TRI, which is typically 100% equity benchmark. And the last one, which is reference index 11, would be 100% CISL bond index. That would typically be 100% debt benchmark. In between that, there is a step up happening, and a combination is happening between equity and debt in varying degrees. You can see it is happening in 10% increments, right? So 90, 10, 80, 20, 70, 30, so on and so forth. In this case, As you saw, when I clicked on run analytics, this entire portfolio got run, and the automatic benchmark really got chosen here, which is reference index 2. This is exactly what will happen when you load in any portfolio, even in your system. What NGEN Markets as a system would do is it will auto benchmark your portfolio with one from these benchmarks, one benchmark from these, right? Currently, as you can see, it is being benchmarked against reference index 2, which is 90% Nifty TRI and 10% CCIL bond index. And that's because it has tried to match the debt exposure in the portfolio to as close as it can, right? In this case, you can see that debt in the portfolio is just about 11.42%, right? So just over 10%. And that is exactly the reason it has chosen this reference index 2 as a benchmark, because it considers 10% as the bond index weight, right? So it will try and closely match the debt exposure in any portfolio that you may load. Okay. And of course, you can see equity in the portfolio is about 81%. There's some amount of cash, some amount of foreign equity exposure as well in this portfolio. And typically, you can actually see that where is this exposure coming from. Typically, for all of this equity bucket, what you will have to do is just click on equity, and you will see all the 81.84% exposure. And where is it coming from? What are the underlying components that actually constitute of this 81% equity exposure really show up here? You can see that there is no particular direct stock holding in this portfolio. But in spite of that, this particular portfolio is exposed to HDFC Bank, for an example. HDFC Bank, by the way, is a stock, right? That is the underlying stock that this portfolio is exposed to the highest extent. 4.31% exposure is coming from one particular stock, which is HDFC Bank. Now you would like to know where is this exposure coming from, because there's no direct stock holding. So all you need to do is click on this I button. The moment you do that, it will show you the underlying funds. In fact, the component funds that actually hold some percentage exposure into HDFC Bank as a security, right? So all of these are the components of your portfolio. Your portfolio has all of these mutual funds, and these particular mutual funds hold some percentage of its holdings into this particular stock. So for an example, Bandhan Sterling Value Fund, which is, by the way, to an extent of 11.11% in the portfolio, holds 2.60% of its exposure, that is of this particular fund's AUM, into HDFC Bank. Now, this 2.60 is of the entire fund AUM of Bandhan Sterling Value. But in this case, in our case, in our portfolio, the weighted, in our case, so in our case, that particular fund is allocated only 11.11%. And that's why the ultimate exposure that your particular portfolio has to HDFC Bank from Bandhan Sterling Value is coming to just about 0.29%. Right? So it's simple multiplication of this, and that is how we come to this particular exposure. If you cumulate all of this up, it is going to come up to 4.31%. That is typically how you can check using this I button what are the underlying components of a particular portfolio. Now, this is also available for even a minuscule component in the portfolio. So as you can see, foreign equity is exposed in this particular portfolio to an extent of less than 2%. And you would like to check where is this exposure coming from. Just click on this foreign equity tab, and you will see that, okay, Alphabet, INC, a typical stock which is listed in US markets, right, is also exposed in this portfolio. Now, where is this exposure coming from? Follow the same process. Click on this I button, and you can see that, okay, Parag Parikh Flexi Cap Fund is a component in the portfolio, and this fund holds some percentage of its AUM into Alphabet INC, sorry. And that is how this particular portfolio is exposed to this foreign holding, right? So this is how our robust portfolio asset allocation analysis will help you in actually dissecting the components of the portfolio. Right. Once this is through, we can then check as to what are the overweight or highest rated or highest held uh, sectors in the portfolio analytics. For that, directly head over to equity sectors, and here you can see that okay, the highest rated or the highest held sector by this particular portfolio is banks as a sector, and that contributes 13.26% in the overall portfolio. Now, which are these underlying stocks? If you would like to see, just click on this blue icon and you can see all the underlying banking stocks that are held by this particular portfolio. This analysis is typically helpful when you have some some news on a particular stock, or maybe some positive news on a particular sector. Let's say you as an advisor typically think that okay, IT as a software is likely to do well in the next 1 or 2 odd years. You want to see that okay, as of now, in the funds that I currently hold or my portfolio that currently has, how much is being exposed or how much of it is coming from IT software as a sector. So you can quickly come to asset allocation and come to equity sectors, and you can check that okay, IT software currently has a weightage of 6.47% in the overall portfolio, and these are the underlines. On the other hand, let's say there's some amount of, let's say some negative news coming in from Infosys numbers, right? Maybe result numbers, or it's not really performed well, right? Then you want to check, okay, how much of my portfolio is exposed to this particular stock. So you can again quickly do that either in the overview tab or even in the equity sectors. Just click on a particular sector, you'll have the underlying stocks exposures, and you can have a look. Okay, current portfolio has 1.15%, which is not very much, not very high, coming from one particular stock. On the other hand, you can see in banks sector, HDFC has a high exposure of a 4.31%. So that would definitely ring a bell that, okay, if there is a negative news on HDFC, you should definitely take a look at the components of the portfolio, because close to 5% of the portfolio is coming or concentrated on only one security, which is HDFC Bank. Right? That is how this asset allocation equity sectors overview would be useful. Let us now move ahead and understand the performance of the portfolio against a benchmark. Because we are considering this entire portfolio of 9 funds, what we have done is we have benchmarked the entire portfolio against the black line here, which is the reference index 2, as we just discussed, right? So reference index 2, as we just discussed, is a combination of 90% equity and 10% debt. Okay, so we can see that now we are running this analysis from 1st of January 2018. That is the start date that is mentioned here. Of course, this can be edited, right? But for an example, first, let's understand this analysis for this 5.5-year period that we are really doing, right? So the blue line that you can see here on this line chart is representative of the portfolio's performance over the last 5.5 years. As you can see, it starts from 1st of Jan, which is a common rebased level for the index as well as the portfolio, right? Both of these levels start from a common start point of 100. And that is exactly the reason we call these as rebased prices and not actual prices. Because in order to make a fair comparison, it is very crucial to actually start the comparison from a common start point, right? Only then will it be a fair comparison, right? So as you can see, till close to 2020, this particular portfolio was actually underperforming the benchmark, and that has been clearly that can be clearly seen from here. The blue line is persistently below the black line, which is the benchmark line. Okay, and that exactly is replicated by this red portion that is highlighted here. That means if we consider 0, I mean, this is a level of, let's say, benchmark level, right? And the portfolio has consistently been underperforming, and that's why it is a negative, right? This is what is signified by the red portion here. This is a loss, loss that is being loss, meaning underperformance by the portfolio versus the benchmark, and that is exactly what is highlighted by these red portions. but you can clearly see a crossover that was really made by this particular portfolio from 2021, right? You can see this crossover point. That is when this blue line has actually surpassed this black line of the index or the benchmark, and it has gone up. It has tried and gone up over that, right? And after that, there has been a consistent outperformance by the portfolio against the benchmark, right? So this is what you can exactly corroborate here as well. So the moment this crossover happened, the portfolio surplus is being indicated by this blue graph over here, blue peaks over here, right? So excess or surplus return over the benchmark, which is exactly what is being highlighted from 2021 till date, of course. That's 21st of September 2023, right? And that is exactly what you can even see in the tabulated manner here. Typically, this graphical representation is for better understanding or better comprehension of the client. But when you actually speak in numbers, it becomes actually a rock solid evidence, right? It becomes more trustworthy for the client as well. So what you can typically see is cumulative return, meaning the absolute return generated by the portfolio against the benchmark from 2018, that is 5.5 year period. You can see that the portfolio has given a 117.86% return over the benchmark, which has given a 101% return. So that's exactly a outperformance by 16%. And that is exactly what is available here. Cumulative excess on benchmark. If you reduce 117 minus 101, that is what is 16%. That is exactly what is corroborated here. Okay, so that typically means that, okay, now this portfolio is outperforming the benchmark. But to outperform the benchmark, what were the risks that were taken by the portfolio as compared to the benchmark risk? To evaluate the risk measure of the portfolio as well as the benchmark, what is typically considered is the standard deviation or the volatility numbers. Okay, and that is exactly what is highlighted here in annual volatility as a row item. You can see that to achieve 117% return, this particular portfolio took an annual risk or annual volatility of a 14.01. On the other hand, the benchmark's risk was a 16.155. Now, it's very easy to interpret that way, that if your portfolio is generating a return at a lower risk, that's definitely a good thing. On the other hand, the benchmark, to generate some amount of returns, it takes a risk which is higher than the portfolio risk. That typically means that the benchmark is riskier than the portfolio. And that is exactly being highlighted here, right? 14% plays a 16% with respect to risk numbers, right? And that is why you can see the Sharpe ratio of the portfolio against the benchmark a higher number. So Sharpe ratio, what does that mean? It's just a risk adjusted return measure of the portfolio against the benchmark. So in this case, you can see that to achieve 117% return, the portfolio took in just 14% annualized risk. And that's the reason the Sharpe ratio of the portfolio is a 0.53, which is a notch higher than the benchmark Sharpe ratio of a 0.39. And that's because it took 101%, it really gave 101% return at a risk of 16.55, right? That's definitely no blinder to definitely go ahead and choose a fund or a portfolio which actually generates better return, and not just better returns, but at a lower risk also, right? So if a security or a portfolio gives you better return at a reduced risk as compared to the benchmark, it is definitely a good thing, or you would definitely go ahead and choose that, right? So that is exactly what is being highlighted here, that with respect to Sharpe ratio as a parameter also, the portfolio beats the benchmark. Now let us come to the up capture and the down capture ratio, which again becomes very, very crucial in understanding the capture or the resilience of your portfolio versus the benchmark in a bull run as well as a bear run, right? So typically when we speak about bull run, we have to focus on the up capture ratio. And why is that so? That's because in the up capture ratio, we will consider as in on NGEN Markets as a platform, will consider only those months, month on month, from January of 2018, when the benchmark gave in positive returns. Okay, so let's say for an example, in February 2018, the benchmark fell by negative 5%. Then that February 2018 month will not be considered while calculating this up capture ratio. On the other hand, let's say in December 2018, the benchmark went up by, let's say, 10%. Okay, now irrespective of the fact the portfolio performed how much, that is not considered as of now. If the benchmark went up by 10%, that particular month will be captured in this up capture ratio. And now let me just show you what was the performance of the portfolio versus the benchmark in a bull run, right? When you click on this I button, you can see that in Jan 2018, the benchmark went up by 4.99%. And that is exactly the reason this as a month is captured in this benchmark column. But you can see the contrast here. In fact, our portfolio gave in some negative returns in the same month, right? So in spite of that, it has been included in this up capture ratio. That's because what we consider is only the benchmark returns to calculate a bull run or a bear run, right? Typically, as we go ahead, you can even see this a starking difference in May 2018, June 2018, because typically this was a period when our portfolio was underperforming the benchmark, right? The benchmark gave in close to 0.10 positive returns. The portfolio in this case actually underperformed by rather gave in losses of negative 1.66, right? And if you just accumulate all of this up as you scroll down, of course, this analysis is going to be available month on month whenever the benchmark is in positive. So as you go down, and we saw the crossover happening, right, after 2020, typically 2021 onwards. And you can typically see the starking difference here. For an example, in February of 2021, the benchmark gave in 5.92% returns. Conversely, the portfolio gave in 7.59. So in this month itself, it has generated an alpha or excess return of a 2%, close to 2% over the benchmark. Now, if you accumulate all of this up, month-on-month performances of the portfolio versus month-on-month performances of the benchmark, that comes to 48% cumulative return of the portfolio. And for the benchmark, it comes to 54% cumulative. And that is exactly the reason you can see this up capture ratio as a 90. So how have we arrived at this 90? That's 48.99 divided by 54.42. That comes to a 90 up capture ratio. That typically means that your likelihood or your capture ratio of the portfolio versus the benchmark, when the benchmark is in a bull run, is a little lower, right? It catches up, but it catches up lower. So the target should be in any aggressive client portfolios that you're trying to build, the target should be to achieve a higher up capture ratio. Higher, by higher, I mean more than 100. Only in that case, you would have built a portfolio that actually outperforms the benchmark cumulatively over the period of analysis for the entire bull run that we are experiencing. The exact opposite logic will work for the down capture ratios. So for the down capture ratio, we try to calculate the performance of the portfolio against the benchmark in a bear run. By bear run, I mean that we will capture only those months when the benchmark actually gave in negative returns. And because the logic is similar, it will exactly work conversely, right? So typically, if it's a conservative client that you're building the portfolio for, the one thing that you should typically note is this down capture ratio should be as low as possible. Why do I say that? Is because you will see that, of course, the benchmark falls, the portfolio will fall, but it will fall to a lesser extent or to a lower extent. And that is how you actually ensure capital protection for a conservative client that you're trying to build the portfolio for. So the lower the down capture ratio, the better it is. And the higher the up capture ratio, the better it is typically for an aggressive client who is trying to outperform or trying to build such a portfolio which tries to outperform the benchmark returns, right? That's the relevance and significance of the up capture and the down capture ratio in this client portfolio review. After that, let's move to the second crucial, sub tab or subtopic discussion on this webinar, which is contribution analysis. So in contribution analysis, what we can actually check is, okay, this return of 117% cumulative is fine, But over this 5.5 year period, I want to know which of the funds actually took my portfolio return up and which of the funds actually, took it down, or in fact contributed to a very lesser extent in my portfolio return, right? So for that, you directly head over to this contribution analysis. This becomes a very, very crucial decision making tool so that you can understand which is the better performing fund in your portfolio and which is not that better performing, or which is not a good performing fund in the portfolio. So when you come to the contribution analysis, you will typically see that all the components of the portfolio will have separate color coded bar graphs, dedicated bar graphs for each of the funds. You can see that, okay, 9 funds, these are 9 bar graphs. Okay, and if you just hover on one of them, so firstly I'm hovering on quant small cap, which I can see the contribution of quant small cap fund to the overall portfolio return of how much, of 117%, is 16.27, right? Just focus on the graph that I'm hovering on. Just ignore these tabulated data for a minute or so, right? I will just come to that in a little while. So what this means is, out of this 117% return, quant small cap, given its allocation in the portfolio, which is again equal allocated, so we need not even go back to check the allocation. It's an equal allocated portfolio. Given its allocation in the portfolio, gives in 16% of this 117. So 117 means 16% is coming from quant small cap. On the other hand, Parag Parekh again contributes around 11%. On the other hand, the lowest contributor is a Bandhan Banking and PSU debt fund with a contribution of a 4.53%. Now, let's for a minute try and make sense of this data that you can see here in the tabulated manner. For that matter, that is even appearing here, right? So this 251 is exactly what is this 251 here. Now, what we really mean by this is that if we consider quant small cap fund in itself, okay, irrespective of the fact it was a component in the portfolio or not, or hypothetical situation for that matter, if you have only one single fund in your portfolio, okay, one single fund, that's it. And if that would have been quant small cap fund, again, time period is same, 1st of January 2018, if you would have had only one single fund in your portfolio return would have been 251% as of 21st of September 2023. And that is exactly being highlighted here. And this can be corroborated, by the way. For that, let me just load in this particular fund in a new tab. So I just click on it. It gets loaded in a new tab. I click on change start date, and I will choose the same start date that we were looking at there. It was 1st of Jan 2018. So 1st of January. And it's right there. Cumulative return or absolute return for the entire 5.5 year period, that is from Jan to 21st September 2023, the cumulative return that was generated by this particular fund was at 251%. That is, if you had only one single fund in the portfolio, your portfolio return would have been 251%. Conversely, in this case, because your portfolio has close to 9 items, your portfolio return is how much? 117%. And now what is the contribution of each of the funds in that particular portfolio return? That is exactly what we are trying to address here. So you can see that, okay, if your portfolio, or let's say your portfolio had only one single fund, which is, let's say, access focused fund, then your portfolio return would have been how much? Cumulative, by the way. This is 5.5 year cumulative return. Only 60% return over a 5.5 year period, right? That's even less than 15% every year, right? So that is exactly what you can see or make sense of this total return column in the contribution analysis. Now, how do you make sense of this second column in contribution analysis? Now, if we standardize this 117% overall portfolio return to 100%, meaning your portfolio, okay, comprises of 9 funds, everything, the return of the portfolio is standardized to 100%, and then you would like to know which is the fund that is contributing to the highest extent in the portfolio return. That is exactly what can be seen here if we standardize that to 100%. Right. So the best contributor is a quant small cap, which is again, corroborating here as well. Quant, you can see the tallest bar graph is here. On the other hand, the lowest contributor is Bandhan Banking and PSU. Now, it is going to be a no blinder to actually, if I just hover here, it is always going to be Bandhan Banking and PSU. That's because its contribution to the overall portfolio return is the lowest. Now, the beauty of this contribution analysis is you can build in this contribution analysis itself, you can build multiple scenarios. Right? So for an example, in this case, what we're considering today is the analysis from 2018. Now, in this entire 5-year time horizon, we have one event, typically COVID, right? COVID as an event. So what we can typically do is we can understand and analyze what was the performance of these particular funds, which were a component of the portfolio pre-COVID and post-COVID. So let's say you want to build internal scenario in this contribution analysis and want to have a look, because typically before 2021, this portfolio was underperforming. Let's see and actually build this scenario of pre-2020 and actually check what was the contribution of the components in the portfolio. So for that, there is a inbuilt or internal to this contribution tab, start and end date given. You can just build in a scenario there. So let's choose a scenario of course, the start date will be 1st of January 2018. And my end date in this case will be pre-COVID. So that will typically be, let's say, February end. Right? So February 28th, 2020, that's typically pre-COVID. The moment I put in the start and end dates, I need to click on run. The moment I do that, you can see the starking difference. Right? When we were doing the entire 5.5-year analysis, we were seeing all of these bar graphs up. That means each of the component in the portfolio was taking the portfolio return up, or basically contributing positive to the overall portfolio return. But we can see at the contrast here that PGIM India mid cap opportunities, quant small cap, Bandhan sterling value, these three funds were actually taking the portfolio return down. Right? The overall portfolio return for a period from 2018 to a 28th of February 2020, that's just more than 2 year, just more than 2-year period. The overall portfolio return, cumulative by the way, has been only 4.06%. Right? That's less than 2% annual return. Right? And that is exactly what you can see here, because there were some components in the portfolio that were actually taking the portfolio return down, which are these. So now conversely, if you had only quant small cap fund as one single component in the portfolio, in your portfolio return could have been negative 19.31 in this pre-COVID period. Right? But because you had a diversification component in the portfolio, I mean, by diversification component, I mean you had one from mid cap, one from small cap, couple of debt funds, right? Bandhan Banking and PSU. In fact, you can see this has been the top performer in the pre-COVID period. Right? Because of that, your portfolio return actually was some amount of positive return. Right? That's definitely a cushion that was provided. This is exactly what the diversification benefit that you can highlight in front of the clients, right? Because your portfolio was diversified across asset classes, your portfolio was, even though minuscule positive, but still positive, right? Better than being a concentrated portfolio to one or two odd schemes. Right? This is how you can actually check the contribution of each of the components across different time periods. Now, let me quickly see that what exactly happened post-COVID, that the contribution changed 360 degrees. Right? So for that, what I will do is, again, go on the start dates and build another scenario, which will now start again from March of 2020. That's exactly the date, I mean the month exactly after this end date, right? So there's a second scenario that I'm trying to build. So 2nd of March 2020, and of course now the end date will be till date, so 2023 September. So 21st of September, click on run. Okay, now I can see that, okay, quant, which was actually the underperformer fund, which was actually taking the portfolio return down, right, has actually become the outperformer post-COVID. So typically small cap, mid cap, all of these have become a flavor of the market in the last 3 years, typically post-COVID. And that is exactly what is being highlighted here, right? Quant, PGIM, sterling value, Parak Pari, Flexi Cap, these contributing to the highest extent in the portfolio return in the post-COVID period. On the other hand, Axis Focus 25, Bandhan Banking and PSU. Of course, Bandhan being debt, it would not be very wise to compare this with the other equity because this belongs to a different asset class altogether. But still, we can see that this has contributed to the lowest extent in the overall portfolio return. On the other hand, you can see this, right? Axis Mid Cap and Axis Focus 25. Again, from the equity bucket, there was a case of front running that had come up, and that's the reason Axis or the Axis AMC funds actually took a hit, due to which Axis Focus 25 has actually contributed very, very less to the overall portfolio return. And that is how you can do a health checkup of your portfolio, right? So this is the fund that is actually causing issues in your portfolio. Right? That's how you can actually robustly use contribution analysis and suggest changes that the client needs to make in his portfolio, or highlight the fact that because you invested at the right time, or you had typical taken positions pre-COVID in, let's say, large, let's say mid cap or small caps that actually performed well typically post-COVID, right? So you can build such scenarios and highlight the strength or the contribution of the components. Okay, that's about the contribution analysis. Now let's come towards the last topic of our webinar, which is discussing the drawdowns analysis and the scenarios analysis. Now, drawdowns analysis as such talks about what was the strength of your portfolio to recover from losses, because how much ever curated portfolio you make, how much ever research analysis you do on screening mutual funds and actually choosing in better funds, taking in, of course, a futuristic outlook, or even for that matter, in this case, historical outlook. But none of the schemes or even the portfolios that you build is going to be ever immune to losses, right? When there are volatile times, your portfolio will definitely make losses. But it becomes very important to note and even highlight to the client that, look, historically speaking, the losses that were made by your portfolio have been recovered completely. And that has been exactly highlighted in this drawdowns analysis. If you have a look at this, these are the top 10 drawdowns that we have highlighted here. The worst, of course, being a 31% drawdown, which is a loss period. And the portfolio recovered the entire loss in 103 working days, right? Let me interpret this for you. So you can see that there was a loss of 31% that was recorded or reported by this portfolio. And that happened between Feb and March of 2020. Again, COVID is to blame here. So from a weighted average price of the portfolio of 110, the portfolio price came down to a 75 rupees, which is exactly a loss of 31% magnitude. Right? And after that, after reporting this loss over just a 1 month period, the portfolio took 103 working days to recover this loss in entirety, right? So that means it reached back to this level of 110. And when did that happen? That happened exactly after 103 working days, after 23rd of March 2020. Now, if we calculate 103 working days, mind you, working days, after 23rd of March 2020, that comes to 13th of August 2020. And that is exactly the date when the portfolio recovered its entire loss of 31% and actually began the growth trajectory. Okay, now this can be corroborated or verified by just hovering on the white portions that you can see on this line graph. Typically, this date is what you should be locating. So I would just hover and try to find a closest date to this particular date. So 13th of August, let me check. Okay, so I have gotten 14th of August 2020. And as you can see, the price over here, 1 second. Yeah, right there. So So typically you can see that the price is actually crossed the 110.31, which is the start price over here. And that exactly happened on 13th of August. Of course, I'm currently hovering on 19th of August, but you can then see that the growth trajectory had begun, right? The start price, it breached the start price hard stop level, right? It actually crossed that level. And that is exactly what we try to indicate by this drawdowns analysis. So typically, if the portfolio, for that matter, has some 10-15% loss going ahead, you can come to this drawdowns analysis and tell the client that, look, as of now, yes, your portfolio is into losses, maybe 10-15%. But historically speaking, it has recovered all of its losses. And if you just ignore these, or maybe, you know, these are exceptions, this 22 and 2018, which took longer days to recover. But other than that, it has managed to recover the entire loss in less than 100 days, or just about 100 days every single time, right? And of course, there are exceptions, but of course, all of those losses can be recovered as well. And that is exactly what you can highlight using this drawdowns analysis. This indicates the strength of a portfolio that you would like to build, or maybe you've already built for the client, right? How resilient is the portfolio in bouncing back from a loss? Last, of course, is the scenario analysis. Again, this becomes crucial also to highlight multiple, caselets or what if analysis tools for the client in different scenarios. So what you can typically do here is you can build a scenario of your choice. Of course, we have given in some inbuilt scenarios, but this have typically become dated now. But you can typically check that, okay, pre-COVID as a scenario that we were just seeing, remember? In contribution, we had actually built this scenario 1st of January 2018 to 28th of February 2020. And that is exactly the scenario that I've saved here. I've named that as a pre-COVID scenario. And you can typically check the entire portfolio was below the benchmark line. The blue line, as you can see, is the below the black line. And that exactly is highlighted here. The benchmark performance in this 2.5-year period was a 11%. Conversely to that, your portfolio performance was a mere 4.06%, right? And that is exactly, I mean, negative return. That's negative excess, and you can that's why you can see excess return is negative 7.73. Now, let's say you want to build your own custom scenario. The process is simple. You click on add custom scenario. A small window will open up. You will name this scenario. Let's name this as post-COVID, because that is the analysis we were doing post that. So this is the post-COVID scenario. I'll put in a start date of, again, the same one. So March of 2020. And end date would be current. So 2023, September. The moment I click on save, this scenario will get saved here. This is the post-COVID scenario. You just click on that particular scenario and you can see the starking difference, right? You can see this blue line consistently above the black line, which is the benchmark line. And that is again tabulated in the tabulated manner here. Right? Benchmarks performance against that of the portfolio. In this case, there's a clear excess return, or the alpha that is generated by your portfolio against the benchmark. Right? This is how you can actually evaluate the portfolio of the client in various scenarios. So typically, I've also created one scenario for Axis front running, right? So because as you can see, we have a couple of Axis AMC funds in the portfolio, and I have just put in the start and end dates, and actually have checked that what was the performance of my portfolio against the benchmark, given that I had 2 Axis schemes. And I can typically check that, okay, there's some amount of underperformance versus the benchmark if I consider this as a scenario, right? So you can build as many scenarios as you would like and actually highlight each of these scenarios by taking in a section specific screenshot to your client. And that is exactly what is our last part in this webinar, wherein we'll discuss the reporting options. So for reporting options, for generating proposals, so we have a robust PowerPoint option, wherein if you just click on this, it will throw up a window wherein either you can create a percentage-based PowerPoint or a more relatable for the client amount-based PowerPoint. Let's say this client that you're trying to build this model portfolio for is willing to put in, let's say, 1 CR, right? So what you will do is you will put in the capital that the client is ready to put here. So this is the 1 CR that the client is willing to give you, and he wants you to generate a proposal for him. You'll put in that amount here and you'll click on create PPT. The moment you do that, a detailed portfolio analytics of whatever we did here will get exported into a PowerPoint presentation. And again, to highlight, all of our PPT, PDF downloads are going to be co-branded. So it will have your own company name and logo on the top. And you can see that this is the analysis report that comes up. So you can see the capital is 1 CR. The moment you go on the second slide, that will exactly give you the split of the capital, right? So 11.11 lakh in each of the funds. And these are the exposures. Then, of course, the crucial drawdowns analysis, the performance tab that gets exported here. the drawdowns analysis that we were just speaking about. And I would like to specifically highlight that the reason that we have not included scenario analysis default in this PowerPoint is again because for different clients, you would like to highlight different scenarios, right? Let's say in this particular case, I would like to highlight that, okay, post-COVID scenario, right? Because pre-COVID, typically my portfolio was not really outperforming the benchmark. So let's say I want to highlight this post-COVID scenario. So what I will do is I will just take a section specific screenshot by just clicking on the screenshot tab, because that is how you can offer customization to your clients, right? So you can click on that, a section specific screenshot will get downloaded. The moment it gets downloaded, you can include that in the PPT by doing this cropping thing. So I'll just take a crop of this. Let's say this is the scenario post-COVID. I crop it up. I go back on the PPT. And I just, because in the PPT, all the customizations are going to be there. Just click on insert, you insert a new slide. And I click on paste. This is how you can actually highlight multiple scenarios. There's no limit. You can add as many scenarios as you would like and make this a customized PPT for the client, which is going to be like a proposal, right? So that's typically about it from my side for the webinar related discussion. If you have any queries, please feel free to type it in the chat box or directly unmuting yourself to speak. Thank you.
Hi, this is Abhilash here.
Yes.
Could you please also highlight on the information ratio and the tracking error?
Sure. Okay, sure. So typically the tracking error that is really visible, of course, in this case, it is for a portfolio. This typically means how different are the returns of a particular portfolio versus the benchmark. It would be better if you typically check it for, actively managed fund versus a passively managed fund, because that is where you will see the clear difference. So for an example, I'll quickly load in, a passively managed fund, let's say index fund, right? So 1 second.
Yeah, hi, this is Arunabh. Yeah, while projector is loading, just so you're aware, for the calculation of tracking error, that is the exact same calculation as standard deviation or volatility. But in this case, we look at the standard deviation of the difference between the fund and the benchmark's return. So we basically create a new series, which is the excess return, which is basically calculated as a fund minus benchmark. And then we look at the volatility of that. So this is the tracking error will basically show you the volatility of the excess return. And as projects are did right now, because it's an index fund, basically you can see the tracking error will be quite low, which means that the fund is doing a decent job of tracking this benchmark. And information ratio is quite similar in calculation to the Sharpe ratio, except what it does here is it looks at the annual excess return, simple, not compounded. It looks at the annual excess return and divides it by the tracking error. So similar to Sharpe ratio, where we take the excess return over the risk-free rate for the fund divided by the volatility of the fund. Here we're taking the excess rate over the benchmark and divided by the tracking error, which is the volatility of the excess return. Generally speaking, tracking error and information ratio are useful parameters to look at, especially with things like index funds. For a free, kind of free moving equity fund, it might not make that much sense.
Hello.
Yeah, please go ahead.
Yeah, I have a query. In your fund performance for the portfolio that you were now analyzing, if you can just come to that, the cumulative return shows that the portfolio performs better than the benchmark. It gives excess return over the benchmark, but your up capture shows that the benchmark performs better than the portfolio. Why are those two different? And when you take a decision based on your cumulative return, that the portfolio is better, but the up capture ratio makes you doubt on that confirmation, right?
Sure. So the up capture ratio talks specifically about how it's doing when the benchmark is up. So the here 90 means it's making a little less money when the benchmark is positive. So you can see in this case, we've clicked the I button in front of the up capture ratio stat. So we're getting all the months where the benchmark was up and we're looking at what the asset did. So it's a little bit less than 100. But on the other hand, you can see the down capture ratio is also good. So the complete picture will be a combination of the up and the down capture ratio. So overall, you can definitely have a situation where a fund is doing well against the benchmark and the up capture ratio is slightly lower because it's making up those returns when the benchmark is down. It's most likely because when the benchmark is down, the portfolio is down less. The first month, February 2018, is a decent example of that.
Oh, thank you.
Thank you. Any other questions? Please let us know.
Please highlight on could you please highlight on the annual volatility over the VAR? How do we discuss on this in this portfolio? Like, how do I tell the clients?
Sure. So annual volatility is a number that basically shows how variable the returns are of this fund. Now, this is calculated. You can actually try it in Excel also. You can just take the returns of the fund and use the STDEV function, which is standard deviation. But basically, the higher it is, the more risk you have in any asset. So, for example, the annual volatility of a liquid fund, for example, will be very low because it doesn't move up or down that much at all. Or the annual volatility of an equity fund will be quite high because sometimes it's up, sometimes it's down. So the variability is higher. So this basically shows you the chances of this fund, displaying returns quite away from the average, which is why it's called standard deviation. So it's deviating from the standard, which is the mean or the average. So in this case, when you look at 14%, it might not make sense individually. It will make a lot more sense if you compare a fund, for example, fund standard deviation with other funds in the same category and kind of see the volatility. So if you're looking at large cap funds, you might want to see what the volatility of one particular large cap fund is versus the volatility of other large cap funds. And in that case, you'll be able to see what are some of the risky large cap funds versus some of the less risky large cap. So volatility is a great measure to basically kind of understand the risk of any investment, be it a portfolio or a fund.
So this can on the positive or on the negative side, right? The 14%, whatever you're talking about.
Volatility will always be positive. Negative, you will never get a negative number because what this does is it basically, the way it's calculated is first of the return series, first you calculate the average. Then for every day, you select, you see the return and you see how much away from the average it is, be it positive or negative. It doesn't matter that it's greater than the average or less than the average. What matters is that it's different. And it takes the absolute value of that. And then we take the average of all the deviations from the mean for the average. So it basically gives you a sense of how much up and down is this thing going to do, right? So the higher the number, that means the more expectation is it could drop to 3% in one day or go up to 3% in one day. It doesn't give you a sense of direction. It is just about how variable or how risky it is. Any other questions? Please let us know.
And also, if you could highlight on the VAR.
Sure. The VAR is basically a short form for value at risk. So this basically shows you, for example, what we have right now is that what you see when minus 20.2%, that is telling you that there is a 5% chance that this portfolio could lose 20.2% on an annual basis. Now, how are we calculating this? This is calculated using the historical returns and looking at what kind of returns we've got in the past. And from that, using standard mathematics and probability theory, we basically tell you that there is a 5% chance in the future that it could be down 20% in 1 year. So when you say 5% chance, obviously it's an unlikely outcome because 5% is a low number. 5 times out of 100, it could be down that much. If you increase that 95 to, let's say, 99, for example, you will see that this number gets even worse. So Prajakta, if you could just type a 99 where it says 95.
Hello. Yeah. So this is exactly what Sir was trying to say. That as you increase the numbers, so 99% confidence interval now, right? That typically means that one second.
Sorry, I got cut off. Yeah, Prajakta, you can finish off.
Yeah. So I was. Okay, so I was just saying that as you increase the number to a 99% confidence interval, you can just see that there's a now there's a 1% chance that 1 second can yeah. Okay, there's a 1% chance that your portfolio could lose 42%, right? Versus the benchmark 43.19% annually, right? That's what value at risk means. So what is the value that is at risk? At risk of what? At risk of losing. Sorry, I couldn't hear you. Can you please repeat?
Ethical and implied, how do you
Okay, got it. So the
talk on this?
Right. So the calculation, the interpretation logic remains the same. Even implied value at risk means the same thing. So with a 95% confidence interval, we can say that there's a 5% chance that your portfolio would lose 23%. On the other hand, your benchmark would lose 27%. This is also taking into consideration the history only. But the difference here is in the calculation, the underlying calculation logic. So historical value at risk number takes into consideration the historical returns of the portfolio as well as the benchmark to arrive at these numbers. On the other hand, implied value at risk takes into consideration annual volatility numbers or the historical volatility numbers or the risk that the portfolio has versus the benchmark. The interpretation will always be the same. Both of it speak about history only. It's not like one is historical, one is futuristic. It's not like that. Both of it speak about historical data only, right? One just bases its interpretation on the calculation logic depends upon the historical returns. For implied value at risk, it depends upon the annual volatility numbers. That's it. Typically speaking, industry standard
So we are
historical
telling that-
value. Yeah. Please go ahead. I was just done.
Yeah. So we are telling that would be the annual volatility what you can expect in future, right?
No, this does not mean what is the annual volatility that you can expect. The interpretation remains the same. This exactly means the same, that with there's only a 5% chance that your portfolio would go down. The returns, this speaks about returns only. This is not volatility. But to calculate these numbers as conversely to this, right, it takes into consideration the volatility numbers. This does not mean volatility would be negative 23. This means returns only. Capital erosion would be 23 versus benchmark's capital erosion would be 27. Just the calculation, underlying calculation methodology is different.
Prajakta,
Yes.
Prajakta, in case of the reference index where you have kept 80, 90, 70, which is their
Yes.
equity,
Yes.
because since it is not possible for you to have different category and different benchmarks over there, that is why you have given reference index. One suggestion is there that it should be, instead of 10% gap, it should be 5%, because in case of volatility, markets are up, measure up, move or down, you'll find a hell of a difference between that equity returns and debt returns.
Sure. So, what you can do is, I mean, we have default given a 10% increments, but you can anytime go ahead and build your own custom benchmark, which will, let's say, have a 5% increments. So let's say in this case, you would like to build a 95.5% benchmark, right? 95 into equity. All you need to do is, one second, I'll slowly show it. Yeah. Go to custom benchmark, click on manage custom indices. The moment you go here, a new window will open up. Nifty TRI you would like to include to an extent of 95. I click here and I add 95% here. Then I would like to add a debt component to it, right? So debt component, CCIL bond index. I click on add index and now I give it an allocation of 5. And this is my 95:5 benchmark, right? I'll just name this as, okay, test 1. And I click on save. And this will be available for benchmarking. I mean, you can just create such series. So test 1, test 2, test 3, test 4, which will, of course, be in increments of 5% as you desire, right? And once this is created, it will be saved for all of your portfolios. This will not be portfolio specific. This will be login specific, right? Even if you load any other portfolio, one second, this will take some time. Yeah, so it's done, right? So you can see here, test 1, right? Now, even if I go and I want to load this portfolio, test 101, I click on run. And let's say I want to benchmark this portfolio against the custom benchmark that I had created. I go to custom, test 1 will anyway be available. I click on this and now the portfolio performance will be benchmarked to this test 1 as a benchmark, right? So this is not portfolio specific. This will be login specific.
Okay, fine. That's great.
Yeah.
And also one more, sorry, just to add to this, that once you create the custom benchmark, our system will automatically update the latest values as the new index data comes in. So you don't have to worry about that. This test 1 will now forever be updated on a daily basis for you.
Okay, that's great. That's great. Yeah. Thank you so much.
You were asking something else also?
Yeah, I was saying that when you in that insight and funds, when you compare funds, there is a category which is called balanced advantage funds and all that. In that, I think that benchmark is not available, because I was trying because I just taken the recent login from your site, so I was unable to know that, which is by default that. Yeah.
Sure.
If you can search from this NSE and all that.
Okay, so if you have any suggestion for benchmarks here, do let us know, because we keep adding them as we get requirements from our users. So if there is a certain benchmark from,
I'll definitely write
do
to you,
let us know.
because because this benchmark which is showing over there, it was not available in NSE and all that. That is why.
Understand. No problem. If you just send us the name, we will look for it and we will add it.
Sure, sir. Thank you so much.
Thank you. Any other questions? Please let us know.
Yeah, could you come to that asset allocation, this one option?
Yes.
Yeah. So here, we detailed view. Can you go to the detailed view?
You want this on a portfolio level or fund level is fine?
Yeah, portfolio level, if you could show me.
Yeah, sure. Yeah. Yes, please go ahead.
This is at a portfolio level, right?
Yes, this is a portfolio level. Yes, this is a portfolio, and this is the asset allocation of the portfolio.
Okay. Can you just click on the detailed view? Okay. What is the derivative stock future, which is the 0.1?
So the moment you click on that, you will see that this portfolio has some mutual funds that hold future positions into a particular stock, which is, for example, Jindal Steel. And which fund does that? Click on this I button. The procedure is simple, right? You click on this I button, you can see that, okay, Quant Small Cap Fund has some derivative future positions taken into Jindal Steel, right? And that is exactly what is being highlighted here.
So I can click on the derivatives option, it will show it, right?
Yeah, here, right, exactly. So derivative, just click on this, it will open this up. Let's say, for example, you would like to check this INVITs, right? Click on this, which are these, INVITs that are really there. So just click on this, it will open up. Click on this I button, you will see the underline, which fund actually holds into this.
Okay. Okay. Okay.
Any other questions? Please let us know.
Could you please highlight on this correlation on the portfolio? How do you interpret?
Sure. So basically, this shows the relationship between the various different parts of your portfolio. So you have lots of funds here, for example, in this portfolio. This shows you how similarly the returns of each funds move together. So these correlation number can go from anywhere from -1 to +1. +1, if you have a 1 correlation, that means that the returns are moving exactly in the same way. So you'll, for example, correlation of any fund versus itself is 1, obviously. But whenever you see a high number like 0.9, 0.8, 0.9, or even more than 0.9, you know the two funds are actually moving very closely together. So you may decide not to have these two funds in the same portfolio because you're not really getting any diversification benefit. So the higher this number, the more care you need to take in terms of, what is the reason that you have those two in the portfolio. You might as well just have one of them. Maybe take away the one that has lower fees or something like that to reduce the cost to the client. But here, the main purpose of this correlation matrix is to basically find kind of overlapping positions, and sometimes you can get some really good insights which you otherwise not think of. Like, for example, you can see 0.96 there. That's Mere Asset Emerging Blue Chip and SBI Equity Hybrid Fund have a very, very high correlation to each other. So you may think about maybe taking one out of there.
Okay. But hybrid, you're talking about, this is the return you're talking about, that correlation is in terms of return, is it?
Yes, this correlation is in terms of return. If you want to see in terms of holdings, then you have to go to overlap. In this case, you can see the same pair of funds, I think Mere Asset Blue Chip and the other one, the portfolio is 32%. Yeah, 32% is the same. Now, what does this mean? That means that 32% of the portfolios of these two funds is exactly the same stocks, right? But the correlation is still very high, which means that the underlying stocks they are holding, they may be different, but those underlying stocks are very highly correlated to each other. So, for example, if I hold HDFC and you hold ICICI, we might still have very high correlation, even though the overlap is 0. So you can, with a combination of both things, correlations and overlaps, get a good idea of how similar two funds are.
Yeah. And what is this distribute?
So that's a frequency distribution. So what it does is, I mean, it's a standard kind of statistical analysis tool. So here, what it does is it distributes the entire set of daily returns, because we've got return period 1 day here, and it basically distributes them into small buckets, equally sized buckets, from the worst to the worst to the largest return, and then counts how many occurrences you get within each bucket. So, for example, what we're looking at right now is 10 buckets, or bins, and each of those buckets have a certain number of daily returns that fall into that range, basically. So you can see this range, which is about minus 0.96 to positive 0.54, has 71% of the daily returns fall within that range. So that gives you a good idea of what kind of returns are most likely to occur. So this basically gives you a nice idea of just probability of the kind of returns that are going to happen. You can get other things here. For example, if you change the 1 day to, I believe we have a 1 month period here. So if you run that, this gives you an idea of what kind of month is most likely to happen. So the most likely month is between 1.5 and 5%. There is a 35% chance of that happening. And then you can check the others as well. So this is a good, good tool to check this. Sorry?
There's a historical one, right?
Yes, of course. I mean, it's data up till now.
Okay, so you mean to say that, in 2000 from 2018 to till date. So what has been the 1 month? How has been the performance? That's what you're trying to tell, right?
Yes, it shows you the different probability of 1 month returns, and the probability is calculated by looking at actual returns over the last 3-4 years,
Okay.
whatever period you have.
Hello, Aruna.
Yes, sir.
This is Kaustubh Vadekar from Pune.
Yes.
You had promised that we'll be able to see the statistics of transition from debt to equity and vice versa in hybrid funds, but we don't see those statistics yet.
Yeah, so you're talking about the asset allocation. You wanted to see how the allocation into equity and debt has changed over time?
Correct.
Yes. Yeah, so that is still on the list. We are getting through it, so hopefully we will get there soon. But that is definitely it's on the list, so we will try to get it done as soon as possible.
Okay, so still some few months away.
I would hope it's less than that, actually. We are almost done with one major project we are working on. As soon as that is out, then a lot of other pending queries will definitely get sorted.
Okay. Another thing, in the asset allocator funds, in the fund of fund category, we don't see the debt equity proportion. So we just see what all funds are there and their percentages. So in fact,
yeah, I mean, so that's a strange problem, I guess. Obviously, because the holdings of those funds show up as mutual funds rather than what is held inside that fund.
right.
So currently we only show one level of kind of drill down, which you can obviously find. But so yeah, right now we're not for example, that's one example. But yeah, right now we haven't really looked into doing this. Projects are just out of interest. Can you just search for this Bharat 22 ETF and see if it actually shows the underlying stocks? Just search for this Bharat 22 ETF in funds. Okay, so they are there. Yeah, so this will take a little bit of time because currently the entire system is built on just having the direct holdings of a mutual fund, we don't ever delve further into the holdings of mutual funds. But we'll try to think of some kind of solution for this.
Yeah, particularly with asset allocator funds. So that is where we realize that this need is particularly there, wherein it's a combination of different types of mutual funds in the portfolio.
Understand.
Asset allocator fund, if you check,
yeah,
you will get to it. Multi-asset allocation, I suppose it does shows. Yeah, so this does show the actual assets.
Yeah, but there are still some mutual funds inside here also, right?
Yeah,
so those you will not be able to see equity, debt, etc. from those.
Correct. Yeah, you can choose any.
I understand the issue. We will try to find some solution for this. But that's a lot of funds in there. For example, this one. Yeah, so your 99% is mutual funds. So you have no idea about equity debt here, right?
Exactly. So that becomes difficult to decide, basically, to take some decision on this.
Understand. Okay, so we look into this.
Yeah, okay. Thank you so much.
Thank you. Any other questions? Please let us know.
No question, but just one compliment that your software is quite good, detailed, and that's properly placed.
Thank you, sir. We're very happy to hear that. We're continuously working on new features, and we hope you like them. Over the next few weeks, we're releasing some bigger changes as well, and we will keep working on new features over time as well. So thanks a lot for the feedback.
Yeah, looking forward to the new implementations. Thank you so much.
Yes, sir. Thank you. So if there are no other questions, Prajakta, we can close for today.
Yes. Thank you so much for joining in. You can definitely check out our past webinar recordings by going on our YouTube channel. So the link for that you will find in the platform itself. On the right hand side, there's a YouTube videos icon. You can click on that. You'll be headed over to our YouTube channel, and there's a dedicated playlist that is created for all the webinar related videos. Close to 81 videos already uploaded. You can definitely have a look at those. So thank you so much for joining in. Have a great weekend ahead, and stay tuned for next week. We'll come up with a new exciting topic. Thank you.
Thank you.